Any questions? In practice, stock splits are much more common than stock dividends. I'll keep going then. So now we've talked about common stock. What's preferred stock? And so we talked about this a little bit in the last class about bonds, right? Really all of these things they're contracts. All we're talking about are contracts. So that's where contract law is interesting for business, right? We can say anything in a contract as long as it's legal. So sometimes we want a financial instrument that is not just equity, but has components of debt, right? As an investor, I might not be comfortable investing in the common stock of a riskier business, but perhaps I still want the benefits of equity ownership. And this is what we call a hybrid instrument, preferred stock. And it's relatively complex. But the idea is it has some fundamental characteristics, but it can have a lot of other characteristics as well. This is just it's a gross simplification. But a separate class of stock, and it has priority over distribution of dividends and liquidation of assets. And so a preferred stock might have, let's say, a 4% dividend rate, and it also will have preference of liquidation. So if the company goes bankrupt, it pays its preferred shareholders first. This is very similar to like debt, right? It seems almost like debt. The only difference is that preferred stock doesn't have a right to principal, right? If I'm selling or buying $10,000 of preferred shares, I'm not requiring the owner to pay me back that $10,000. I'm just requiring a fixed dividend, and I'm requiring that if they go bankrupt, they pay me as much money as they can back before they pay their other shareholders. This normally has no voting rights. So I'm not actually an owner in the business. I just have rights similar to owners. And it normally has a stated dividend rate. Most companies don't have preferred stock. Most of the companies that do have preferred stock are companies that were private and recently went public. People that normally, or entities that normally want preferred stock are like private equity firms, because it has unique characteristics. There can be a lot of characteristics. I don't want to, I'm oversimplifying it here just so you can understand it, but really these can be structured in any way legally, right? It's legal paper. They can say it's cumulative or non-cumulative. So if they pay dividends, if it's cumulative, that means they collect the dividends over time. So like if they can't pay the dividends one year and they owe 4% for that year, next year they'll own 8%, and then they'll owe 12%, and then they'll owe 16%, right? It'll increase every year until it can all be paid out, and then it'll be 4% a year. Non-cumulative means, hey, if they can't pay the dividends, they don't owe it in the future. Let's go over this fact set. The board of directors declares $5,000 of dividends in 2016. The board declares and pays cash dividends of $42,000. So how does it get, now that we have multiple tier of stock, how does that flow out? On the multiple tier of stock, we have common stock, $10 par value, 50,000 shares outstanding, authorized, and 30,000 outstanding, which is worth $300,000. The preferred stock is at 9%. That's what we're saying is the rate that it could be distributed at. 1,000 shares authorized and 50 shares issued and outstanding. And then here's our paid in capital in excess and our retained earnings. And so how do we figure out how much is paid out? We'll do it through this kind of calculation. So we issued the preferred stock, say here. Let's see, does it tell? I guess it's saying here, preferred stock is cumulative. If it's non-cumulative and it was issued in 2016, how do we do it? Well, the preferred stock should be getting $5,000 a year. Let's see how to get that. 9%. Oh, the $5,000 of dividends. Okay, they're 42,000. Let's see, I'm trying to figure out how they. Yeah, it should be 9,000. That's what I figured. So this preferred stock, 1,000 shares authorized, $100 par value. So each share should get 9. So there should be $9,000. times 1,000. There should be 9,000 in preferred dividends given out, $9,000 preferred dividends given out. If it's cumulative, their dividend in arrears, so the first year they pay $5,000. That's all they've been able to pay. They say here, declares $5,000 in 2016. And then the next year, they're able to pay $42,000. So you see here in the first year, we only pay what we're able to pay, the $5,000, if it's cumulative. Then the next year, we still owe the remaining $4,000, which is called dividend in arrears. And then we also owe the $9,000 of the new year. So we owe $13,000 in 2017. And then our total amount we've paid out is $18,000. The common stock amount is whatever's left over, right? So in year 2016, since we haven't paid enough to our preferred shareholders, common equity holders get nothing. And then in year 2017, they get 29,000. They get which is that 42,000 minus the 13,000. And then this is the total amounts. If it's non-cumulative, that 5,000, that 9,000 amount doesn't reset, right? We don't owe that 4,000 in year 2017. So as a common shareholder, before you invest in a company, it's worthwhile to look to see if they have preferred shareholder rights, right? Because if they have preferred shareholder rights, when they issue dividends, you have less of a right to those dividends. And it also matters if it's cumulative or non-cumulative, right? If I'm a common shareholder and I want to invest in a company, then I want them to have no preferred shares. And if they do have preferred shares, I want them to be non-cumulative. If I'm a preferred shareholder, I want a cumulative preferred share, right? So that's kind of what I might ask you from an accounting question is like, or from your midterm or final, I'll ask you about what are some of the characteristics of a preferred bond or a preferred share. So what are some of the characteristics? That they pay dividends, what's right here, right? Usually has a stated dividend rate and no voting rights. I might also ask about cumulative versus non-cumulative and how to calculate these amounts. This is another type of feature on preferred stocks. Remember, there's unlimited amounts of features. These are just buckets of some common features. I'm not going to be testing on this so much. Just know that it's available. Participating versus non-participating. So what happens after that 9%? That's what that's saying. If it's participating in the excess, they get an equal amount of that dividend. If it's non-participating, they only get that fixed rate. So if it's participating in this situation, some of those preferred shareholders would get this remainder 33,000 or 29,000. If it's non-participating, they don't get any of the remainder. It only goes to the common shareholders. And so these are just some more examples. I'll let you go through yourself. Any questions related to this so far? Okay, we have some more complex topics. So I'm going to give you guys another, maybe a 5-10 minute break. We'll come back at 10:10, and then we'll go cover the rest of this. It'll probably be about 30 minutes after. We talk about treasury stock, and then we're going to talk about earnings per share and dividend yield. So we got still some interesting topics, but we'll come back at 10:10 and wrap this up. Awesome. Okay, have a good break, everybody. So now we're going to get into this interesting concept called treasury stock. Now, why is this important to you? Because you should have heard news about this in the last few years, right? One of the big debates about the stimulus money is how do we prevent stock buybacks? Now, why would a company want to buy back their own stock? So the question was like, hey, what the stimulus money do? Should companies be able to repurchase their own stock? Well, if companies purchase some of their own stock, it drives up the price of the stock. And pretty much the company is investing in itself. It's removing some of the stock from the marketplace and in exchange, holding on to it so it could resell it in the future. It's investing in itself, but it also by buying those shares, it drives up the stock price. And so it was controversial with the stimulus because the stimulus was supposed to go towards keeping employees on payroll, not increasing shareholder value. But we're not concerned with complexities. I'm not trying to argue one way or the other here. I'm just trying to explain why this is important and why a company might do it. But what does this mean from an accounting perspective? This is called treasury stock, when a company is buying its own stock. from the open market, and then we can resell it. So on May 1st, Cyber purchased 1,000 of its own shares on the open market for $11.50 a share. So how do we account for this? It's strange, right? Like, is it an investment or is it a reduction to equity? Well, what we're going to do is we're going to show it as a reduction to equity because it's our own shares. And so this should hopefully discourage some investors from companies also from buying it and trying to overinflate their assets, right? It's really a reduction to equity. So we'll credit our cash $11,500. That's what we're paying for our stock. And then we'll debit our treasury stock, $11,500. Treasury stock is a reduction to equity. It's a contra equity account, similar to like an expense. Let's see. On May 21st, and then let's say we sell them in the future. We debit our cash, and then we credit our treasury stock. Easy, right? So we're just kind of classifying this in its own line item, treasury stock. This is at cost. Look, what if we have a gain or loss? What if we invest in our stock and we have a gain? So we sell it above. Where would we track that gain? Well, we're not actually going to call it a gain. We're not going to recognize it in the P&L, the profit and loss statement, or the income statement. What we're going to do is we're just going to increase it as a paid-in capital treasury stock. So we'll debit cash $4,800. We'll credit our treasury stock, common stock, and then we'll credit an additional account called paid-in capital treasury stock. That's the profit, the $200 profit. And this is how it's calculated down here. What if we have a loss from that trade? We're going to decrease our retained earnings. If we have any paid-in capital treasury stock, we'll hit that first. Think of it like a shield or a force field or barrier, right? Like that gets hit first and then drained. And then anything remainder has to go to our retained earnings, a hit to retained earnings, which is the worst case, right? We don't want our retained earnings to get hit. So if we have a loss for the rest of our shares, we sell an additional 500 shares at $10, right? That was a loss from the $11.50 originally. We'd have that $5,000 in cash we receive. We have $5,750. That's what it was worth originally. The 500 times the 11.50. And then the difference, the loss of $750. First, we reduce this $200 paid in capital, and then whatever's remaining would be the $550. So think of it as like a barrier or a shield that we have to get through until we hit retained earnings. And then so here's an example question. Common stock, $10 par, 500 share authorized, 200 outstanding. Well, we've done this before, the same example. We purchased 30 shares, treasury shares at $20 per share. What's the journal entry? We debit the treasury stock, 600, credit cash. Right, that treasury stock is going to be on our statement of retained earnings, what we did up here. Where is the first entry? Here. And this treasury stock is going to be a reduction of equity. Right, it's not an asset. It's a contra equity account. And so that could be a question for your test, right? What is treasury stock? It's a contra equity account. Then on September 1st, we sold 20 shares at $26 a share. Well, that cash's amount is equal. It's always easy to calculate, right? It's just the fair value times the number of shares. $520 in cash. Our treasury stock is at cost. So that's 20 times the $20 up here. So that's 400. And the difference we get paid in capital treasury stock, right? You can think of this as a gain, but we don't report it as a gain. Just our paid in capital treasury stock. And then our last entry, we sell the remaining 10 shares at $7 cash per share. And cash is 70. Then we'd have our treasury stock, we calculate at cost, 10 shares times $20 cost. And this is what we can think of as our loss. We have $130 of loss, but we can only hit $120 paid in capital. The rest, the $10, goes to retained earnings.